Greetings, fellow investors. Hope you're all staying safe and doing well, especially during these divisive times. Today we have two stocks that I'm going to be going over that have the potential to put money in our pockets. Guys, I don't know about you, but I always love when I check into my pockets and I realize that there's money in there that I didn't even know was there. So I try to find these great companies and bring them on your radar. Let's all try to make these financial dreams and goals that we have come true. So these videos actually take a lot of time for me to put together, and the algorithm does not do me any favors in pushing out any of my videos. So I'm definitely not like a Graham Stephan or me, Kevin. So be sure to touch that blue like button and subscribe to the channel. All right, guys, let's get started here. So the very first stock we're going to be talking about is a no-brainer in my opinion, and that is one of my favorite sectors, and it's in the card processing sector, and that is the giant company that's Mastercard. Mastercard recently announced its earnings, and the stock has plummeted nearly 10% since. Revenues fell 14% year over year and were particularly hard outside of the US. But this shouldn't really be a shock to anyone because of the ongoing C-19 pandemic. Of course, people aren't going to be out spending money as much with lockdowns, booking vacations on cards, or doing business trips. None of that is going to happen as frequently because we're in this lockdown. I mean, is water wet? Is a hot dog a sandwich? To me, I think that a company that is as well established as Mastercard is, any sort of significant sell-off is a prime buying opportunity. Now, Mastercard could be hit even harder here in the short term as we head into those winter months, which could mean even more lockdowns, which means less economic spending occurring when cards are not being swiped as much, which is going to hurt Mastercard. Now, not all is gloom and doom though. For Mastercard, they actually got more gross dollar volume in Q3 compared to last year. Now, this is simply just the dollar amount, not the actual amount of transactions, which could include more processing fees, etc. So that's definitely a positive sign. You can see here, this is exactly why Mastercard was really hurt in their cross-border volumes, which are down considerably, down 36% year over year. Their own CEO even said that traveling spend is a big challenge right now for them. But they are winning businesses in core payments and other digital solutions. Mastercard has no problem spending money either. In Q3 2020, they repurchased over 6.5 million shares, costing them nearly $2.1 billion, and gave us lucky shareholders $402 million in dividends. Now, a company may repurchase its own shares if it feels the market is undervaluing the share price. I don't necessarily think that's true with Mastercard, as it's traded at a premium considerably higher than its historical PE recently. Share buybacks, when done correctly and responsibly, can improve a company's financials, and then they also don't need to be paying out as much in dividends. We don't want them to be pulling a Boeing and spending all their money on buybacks. But looking at their most recent balance sheet, they've actually increased their cash position to $10.2 billion in cash and cash equivalents, which is up from $7 billion at the start of the year. They also have a really good current ratio of just under 2. That tells me that they're in pretty good financial health. I mean, come on guys, this is a company that made just under $5 billion in pure profit in what was considered an abysmal year for them. I'm not sure that justifies a 10% drop. There are over 2.7 billion Mastercards in circulation. Mastercards get a small fee on every one of those transactions, regardless of where in the world it occurs. They actually don't take on any liabilities or issue credit of their own cards. That's actually what a financial institution like a bank does. This is a common misconception people have about card companies like Mastercard and Visa. The fintech industry is going to be exploding in the next coming decade, as much of the world still uses cash. I understand the reason for this sell-off, but I personally think it's a little silly, and I try to put my money where my mouth was, and I actually bought more of Mastercard and Visa on Friday. So Mastercard is a perfect example of a stock that I am going to be buying, stashing, and collecting cash from. All right, guys, I usually talk about blue chip companies a lot on this channel, but this next stock is anything but that. They actually don't even turn a profit, and they were a penny stock as early as this year. Before we talk about this stock, be sure to hit that like button if you're enjoying the content so far, and make sure that you're subscribed. The stock that we're talking about is Plug Power, also known as the Plug. They've actually been around since 1997, but they haven't actually made much noise till recently. Plug's main business model is providing hydrogen fuel cell systems that use hydrogen to produce electricity without all that combustion. This works very well with companies that may own a warehouse, aka basically every company, and needs to operate a forklift or an automated guided vehicle or an AGV. So some of their big customers are Walmart, Amazon, Kroger, I made sure not to add an S in there, and Home Depot. So you may have heard of some of those companies. So using hydrogen over fossil fuels is actually better for the environment as it reduces the amount of carbon emissions. That's certainly the direction the world is heading into, or is trying to head into, as we try to eliminate fossil fuels, which means governments often give tax credits or subsidies to encourage the use of alternate solutions. It certainly helps when you have a company that the market has a high sentiment for making the world a better place in your back pocket. Though, just a word of caution here is that just because the government may be offering incentives today doesn't mean that they always will be. Similar to how the government used to offer incentives for Teslas, but now those are really just phased out. Still, unfortunately, most of the hydrogen produced in the US still originates from natural gas. So Plug is hoping to produce 50% by 2024 from something called green hydrogen, which is actually a renewable energy resource. So Plug actually plans to build a giant gigafactory similar to Tesla to make PEM stacks for electrolyzers and fuel cells. But here lies another problem for Plug, is that the advances that companies like Tesla are making with their battery technology, it's gotten so good that it now threatens the hydrogen fuel cell market. Tesla is working on reducing its battery prices by 56%. That's often the most expensive part on a Tesla car. And that's just going to be making life much harder for Plug's margins. It's very well possible that batteries can leave hydrogen fuel cells in the dust in this green, clean energy industry. To help combat this, though, the company has actually recently acquired fellow green company United Hydrogen and Geiner ELX to accelerate their green hydrogen strategy. Plug is also guzzling through cash at quite the rapid rate, and it's offering new shares to raise capital, or in other words, they're diluting existing shareholder positions, and that's probably not making us investors quite happy. But some positives is that their revenue growth has actually exploded here in the last 4 years, going from $83 million in 2016 to $230 million just last year. But their margins, that's actually quite the different story. Margins are basically the difference in how much they're making in sales and then the cost of those goods sold. And it's very slim, it's very spotty, and it's often very negative. The company announced, though, in their latest earnings call that they were reaffirming their guidance of nearly $110 million to $115 million in revenue, which is definitely a step in the right direction for a smaller company to be bold during the pandemic that we're going through. To reaffirm their guidance is definitely positive, and they're looking for more expansion options in Europe. So this is a continent that is considerably ahead of North America when it comes to investing in green energy options. So this expansion to Europe can certainly help Plug in raising those revenues and maybe increasing those profit margins finally. So Plug is up nearly 500% in the last 5 years. Let me repeat that. In the last year, Plug's stock price is up 500% and now has a market cap of $6.6 billion. So yes, this stock is definitely probably reaching the overvalued designation right now, since it actually doesn't make any money and its revenues are pretty minuscule. But I want to hear what you guys have to say. Is this a great renewable energy company? And can they continue these consistent returns that they've been doing in the past year? And can they also consistently just be profitable, something that they haven't ever been able to do? This company has been around for 20 years, and maybe that's taught us something. Maybe it's taught us that maybe we just can't trust them to turn profits, and they will only continue to get crushed again in the future. Anyway, I'm not sure if I'm going to be buying any shares a plug, but I really do want to hear what you guys have to say. I know it's a really popular stock here in the investing community. As always, if you guys have any questions, leave them for me below. Message me on Instagram if you guys ever want to discuss stocks, if you guys ever want to discuss anything about life. My DMs are always open. Be sure to subscribe to this channel for more weekly videos. And I know last time I mentioned that I would be making a video about how I transitioned from Robinhood to Fidelity and the steps that I took. And I know you guys really want to see that video, so I'll be sure to be working on that this weekend, and I'll have it out for you guys next week. All right, guys, let's go get those gains. Talk again soon.